Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, December 14th, 2022. It's 2:10 p.m. Eastern Time as I'm starting the video. So we have the FOMC meeting out of the way. In about 20 minutes, Powell will come on and do his dog and pony show in front of the media, so that may also send the market one way or the other. And and like I say, I usually like to let the dust settle. This is what I call post-FOMC noise. The market usually rips one way, then the other, and then sometimes the other again. But I wanted to get this video out. I'm still not feeling so hot. I'm going to pause the video quite a bit here. I'll try to pause it before I cough. It's hard to talk, and well, I've been coughing all day, and when you talk, it makes it worse. So I will do my best not to cough into the mic and get this video out to you guys. All right, so really no change. I kind of went offline last couple days, not posting much because I'm not feeling well. But there's same story. This is the primary downtrend line on the S&P 500. You popped it intraday yesterday, although that's a green candle. I have my candles set to color code depending on how they close the day. So that was we closed well back below the trend line. We closed down here at the lows. Not much. We barely, it was a slight positive gain for the day, but one heck of a fade. So that is, of course, a rejection off the trend line. We tried to pop it intraday, gapped up, and they sold it hard afterwards. As I mentioned, I thought that was a good gap fade trade at the open yesterday. Here's where we're at today. So we're still below there, so no change. And we're also, as you can see right now, the blue line here is the 200-day simple moving average, and the red line is the 200-day exponential, and we're right on those. Those are key levels in bear markets that often cap rallies. And then this line right here, that's shows right here. Let me tighten that up a little bit, just fix it off the top of that candle to that candle. It shows we have some negative divergence too on the rally into that trend line, so we'll see if that plays out. And the bottom line is we had this trading range, which I said is we're likely to do before the Fed, and that's what we've done. So it's a little more clear. I'll get to QQQ in just a second, but let me box it in for you here. So there's the trading range, and pretty much bullish if we can break above there, because you take out the trend line, you clearly take out the 200-day moving averages, and then bearish if you break down below. So that's it in the most simplistic view. That's what we're looking at. And then, well, let me turn on another board here. All right, so this is the S&P 500. Same trend line. I just have a lot more lines there, and then I have the what I call my most likely bear market rally bounce target zone right here, which is an objective shorting level, anywhere into from the bottom to the top of that, but not above. And this is what I call my still potential bounce target zone. Again, most likely is where I think we'll stop, and then potential is we can go all the way up there as long as we don't get above there. So my plan was, and still is, let me jump to QQQ and I'll show you there. I've said this many times. My plan is to start scaling in back into swing short positions for what I believe will be the next leg down the bear market. Starting here, which I did there, and of course we hit that trend line. You don't see it here, but I posted that. I give you a chart in pre-market yesterday. We popped right up to the trend line there, and that was an objective short. And we also put us in the middle of my most likely bounce target zone, the red box there. So we had one there. And the way it works now, if we push up, I'll continue to add up to the top, but no longer above there. I'll sit tight on those positions, but this is just like the S&P. This is my possible bear market rally bounce target zone. Why I say possible? Anything much above that, you take out the previous highs on both the SPY and QQQ, and it just really whittles away at the case for a bear market. So that's where we're at. So really no change recently. And then you can see that trading range here pretty well on QQQ. Remember this candle yesterday, we closed at the bottom of it, so that's about the top is right at, well, yeah, whatever, right about there. And same story, if we break below it, you can see it's really nice support at the bottom of that zone, about 279.70. That's going to clearly be bearish, and I think could spark a pretty powerful wave down, and pretty quickly, I think, quite possibly take us down to new lows in a pretty fast in quick fashion. Likewise, if we can pop above here, remember that's where we popped in pre-market. We hit the 200-day moving averages. Both the simple and exponential come in together perfectly at the downtrend line, the primary downtrend line right here. So those are your levels. Pop that. It's hard to argue that as anything but bullish, especially if you have a solid daily close above there, and pop below there. Hard to argue that as anything but bearish. Okay, and a quick update on the PPO crossovers. Remember these PPO crossovers, the bearish crossovers here have pretty much come at right off the highs of these bear market rallies. These are trend change indicators, and this is the last one we had. So those are still in play. We're close to crossing back above. So again, if we pop above there, it's going to put the histogram, the PPO histogram green, but as of now it's red. And in a bear market, there are some whipsaws. I've said that before, but typically you've captured the biggest downtrends in the bear market have been when that histogram's been red, as the biggest rallies have been when the histogram's been green. So we'll watch that. We're still red on the S&P 500. You can see there, and all 11 sectors in the S&P 500: technology, XLK, XLV is healthcare, XLF is financials, XLC is communications, XLY is consumer discretionary, all red. XLI industrials, XLP consumer staples, so forth and so on. There's energy. Oh, let me talk on energy because that's been a trade. We had and I'm going to get to crude oil in just a second too. I want to loop that in. Let me park the PPO there. We hit the first target, T1, and I told you I expected to bounce off T1, at least up back to that S1, and you can also draw a downtrend line off the highs here. So this would be the likely bounce target. Anywhere up to S1 it's really S1 R1 now. S1 means first support, or S support first support level. Excuse me, I'm still foggy headed. S1 is now R1, resistance 1, and that's where we went. And we could pop a little higher and hit that downtrend line. And yes, I think the outlook for crude and natural gas is bullish. Natural gas has ripped lately. We know that. We got in here right there, nailed the bottom on that one. And it's been a few pullback trades in between. But remember, it's coming off this big divergent low. There's a primary uptrend line right there off the 2021, or actually the 2020 lows. And so, commodities remain, especially energy. Energy has a much bigger impact than, say, soybeans or something else, or cotton. So we want to watch this. And of all, crude is the biggest. Crude will have a bigger impact than nat gas, but they both have a pretty significant or measurable impact on inflation. And so USO also put in a divergent low recently, right here, just above this trend line, this uptrend line right there. Positive divergence right there, and it's at resistance now, so it might get a little pullback here. But if this divergence plays out and we're in a bull market in crude, that could send us quite a bit higher. And so it's something to watch. And if you continue to see, or you see a revamp, remember this is that whole abatement in inflationary pressures that have led, or coincided with the stock market rally. And this is what I call the bane of Powell. It's going to be a thorn in his side going forward for quite some time. I think every time that they kind of back off, like I said yesterday, and whether it's an actual or perceived pivot towards less. I don't want to use the word dovish. Dovish really implies rate cutting, but less hawkish is the right term to use. And we'll watch that. And then of course there's all the other commodities as well. I'm just rifle through. Here's unleaded gasoline. That's going to put a pinch in everyone's pockets. Divergence right there. UGA's unleaded gasoline ETF. And then you go through all the different commodity ETFs, and they all have the same thing. They're coming up on trend line support. We could get one more jog down because quite a few of these have reversed just a hair shy of the uptrend lines. But either way, if you do get that one more jog down to hit the trend line and then reverse, you're still going to have the positive divergence here. Let me just drag that line out a little farther. So this one's GSG. I've been using also DJP is a well-balanced commodity ETF, and then you also have a downtrend line that could pop and run. So keep an eye on this. If you, I do believe, and I think the case can clearly be made, and I've done that we are in a new bull market. This is DJP, one of the most balanced, diversified commodity, diversified commodity ETNs, and that was the peak of the last commodity bull back in 2008. And then we started a bear market, pretty powerful one, which was unusual because usually commodities are going up with the stock market, but we were in a deflationary environment after the financial credit bubble, financial collapse back in '08. And since then, we've started what I believe to be, and by every metric in technical analysis, a new downtrend. We took out, I'm sorry, a new uptrend, a new bull market. We took out the downtrend line. That actually should go back all the way to the top. That's the primary downtrend line I just drew. We took that out right here. We've taken out several previous reaction highs, and we're just zigzagging higher. So we could come down a little more, certainly, or not. But again, by most metrics, this is early stage bull market action. And so that's going to, in my opinion, continue to put inflationary pressures on the economy for quite some time to come. Okay, guys, I've paused the video several times. I'm coughing quite a bit here. I'm going to have to stop the video, and then I'll try to do an update. Maybe I'll just get some screenshots of a couple charts out for gold and treasury bonds and all that. But I'm thinking we may still see some pressure on gold. I'll watch. I want to get to the U.S. I'll do this again. I was going to cover it in here, and I'll do it in another one. But the euro U.S. dollar. It's taken out the bottom of that long-term major resistance zone, but this is a weekly chart. You have this downtrend line here, so it's been a pretty strong run in the euro U.S. dollar pair. So if we get a pullback here near term, that's going to be most likely put pressure on gold and silver, and also the stock market, because there's been a very high correlation. If you look at the stock market, which I'm done here, in white is the euro U.S. dollar pair, and green is the S&P 500. So pretty much the stock market has been all year going moving up and down in lockstep with the euro, or inversely with the US dollar. And so that's something I'm watching very closely, and I think there's a decent chance we can get a rejection here. And you look at the 60-minute chart, that's busy. Let me move that histogram away. Let me go to the daily chart for you. You can see there's some negative divergence forming in this wedge pattern here. I have the downtrend line a little lower, but you know what I missed? I didn't get that high there. I'm going to take this trend line right here and make it line up a little better with the weekly. Doesn't want to move. There it is. Okay. That's a little better, coming and capturing that high right there. But either way, we're a hair above it with some divergence, and also, again, the way I have the trend line drawn on the weekly, we're right at it right now. So if we get a pullback here, then that should put pressure on both the stock market and gold and silver. If we can clearly take it out and burn through the divergences, well, hey, that's going to be bullish, and that would help support the case for a rally and a breakout above those levels I just showed you earlier in the stock market. And likewise, if we go down, especially if we were to go down, I think this would be a logical target. If this wedge breaks out right here, this bullish or bearish rising wedge, excuse me, if that breaks down, then this is a logical target, this uptrend line right here. So you could time trades on gold in the stock market and silver with that, should that again break down. We don't have a sell signal yet. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.